Hey all, welcome to ShareTrack. This is Raj here. This is the second episode on our options training program. I must confess that John, Sam and I have been having a great time trying to do a little bit of acting in our skits, and I hope in the second episode we are going to be better than we were in the first one. Of course, we have improved the production quality also out here. So you should enjoy the second episode better than the first one, that I can assure you. Now, having said that, let us do a bridge between the first episode and the current episode that we are doing. In the first episode, we took the example of the car, which is the underlying, and then Sam got an option from the car dealer to buy the car at a set price by 31st of December, and he paid a premium of $500 for that privilege. And later on, he sold that to his friend John for $550 and made a profit of $50. And John went to the dealer before 31st of December and bought the car at the set price. So we saw car as the underlying, which is a common thing. Now, in today's episode, instead of the car, we are going to talk about Microsoft stocks as the underlying. And then I'm going to show you 3 slides now. I'm going to walk you through the slides, which will make you transition effortlessly from the car example into the stock example, because there are a few more extra information that we need to put around the stocks for you to understand what a call looks like. The first thing to understand is that the definition of a covered call option is that a covered call option gives the option holder the right, but not the obligation, to buy 100 shares of a particular stock or the underlying issue at a fixed price, strike price, prior to a fixed expiration date. So what will happen in this particular case is if someone bought the covered call that you sold, they may or may not decide to exercise it. And the chance of them not deciding to exercise it will depend on the price at which the stock is quoting on the expiration date. If the stock price is higher than the strike price on the expiration date, they would go ahead and exercise it. And they can also exercise the option to buy it anytime before expiration. The option buyer pays a premium, and that is the cost of the option, and the option seller gets to keep this premium. And he gets to keep the premium no matter what happens. If the option owner exercises the option seller is obligated to deliver the 100 shares of stock to the option owner. So the key points that you can take from this entire slide is, first of all, that the lot size for these shares is 100. So 100 shares make a option. And right now we are selling a covered call option, which means you need to have the share that you're trying to sell as a covered call. So you need to have 100 shares of, let us say, Microsoft if you want to sell one covered call of Microsoft. One covered call of Microsoft consists of 100 shares of Microsoft. The option buyer will pay you a premium, which is the cost of the option. You get to keep the premium no matter what happens. However, if the option buyer were to exercise his option to buy the shares at the strike price, you are expected to provide the shares to him. But in case the option buyer does not exercise his or her option to buy the shares, then you not only get to keep the premium, but also you get to keep the shares. So that's what you need to take from this particular slide. The second thing I wanted to talk to you about was that when options are traded, there are 3 players involved. In modern day, it becomes very, very transparent because you're just dealing with your trading platform. You don't have to call anybody or anything. You just do your trading on your trading platform. But what happens behind the scene is that there's an options exchange where options are traded. The exchange provides a physical place or computer system for options to be traded. It also decides what options are to be traded, what underlying issues, expiration date, and strike price the options will have. And then a clearing corp is present, which maintains a record of all the options traded. The clearing corp takes the opposite side to each trade. The buyer pays the premium to the clearing corp, and each seller gets paid by the clearing corp. The clearing corp also guarantees that if an option is exercised, the shares will be delivered to the exerciser. So that's the role of the clearing corp, which is the second entity in this picture. The third player is one or more clearing firms or brokers who act as an intermediary between option buyer and the clearing corp, or the option seller and the clearing corp. So that's how it happens. And in this particular episode, I have played the role of a covered call seller. John has played the role of a broker, which is which is this part, the third part. And Sam has played the role of a clearing corp. So that's how we have structured this particular episode. And then the other point I wanted to talk to you about was that the way the option is defined on the options exchange is very important for you to understand. It consists of a series of alphabets and numbers. And that's what I'm trying to explain in this particular slide. The option information contains an indications of call or put. So C means call and P means put. And the option information contains the symbol denoting the underlying security. In this case, MSFT is the ticker symbol for Microsoft on NASDAQ. The option information contains the expiration month and year. In this case, March 23 is the month and the date and the year. And the option information contains the strike price, the price the option buyer will pay to the option seller if the option is exercised for a call option. So the last 3 digits that you see here, 255, is the strike price. So the example we have shown here on the exchange, it will read as C MSFT MAR 23 255. It means a call option of 100 shares of Microsoft stock. The option expires on 3rd Friday of March 23rd. If the option is exercised, the call buyer will pay the call seller $255 per share, which is $25,500. With that said, let's get started with our skit.
John, I want to list some new stock options, a class of options from Microsoft. It's a pretty hot stock. It's currently trading at about $249, and I think we should issue a class of options for Microsoft at 240, 245, 250, 255, 260. I mean, we don't want to make the price too far away from its current stock price, because then I don't think people are going to want to trade that option. Yeah, and basically anything more than 9 months away is just too far in the future for people to be interested in risking their money. So let's do it for only 9 months for each of those prices. That way, we should get enough business to justify having these options listed. Why don't you help set up the class?
Going to do it right now, Sam. Let's see here. So we're going to set up the options class as call Microsoft February 23 240.
Right.
Call Microsoft February 23 245.
Yep.
Call Microsoft February 23 250. And call Microsoft February 23 255. And call Microsoft February 23 260. All right. Now, we're going to do it for March too, right?
Yep.
So call Microsoft March 23 240. Call Microsoft February 23 245. Call Microsoft February 23 250. I'm sorry, March. Call Microsoft March 23 255. And call Microsoft March 23 260. And ...
You know the rest.
Yeah. Yeah, I
Great.
do. And I've got it all right here.
That's great. So now let's post them up so that the brokers can see it and they know that we've added this these option series, and tell the clearing corp so that they know that they're going to see trades on those option series. And don't forget to let our own trading system folks know about them.
Okay, Chief.
There you go.
Bring, bring. A customer. John's Brokerage.
Hi, John. This is Raj here.
Hi, Raj. What can I do for you?
Hi, John. I want to sell an option of 100 shares of Microsoft. I see that you have got the options listed in your system.
Yeah, we've got them all. What series would you like to sell?
Well, here's my thought process. You can correct me if I'm wrong. I think the stock price will go up in the long run, but over the next 4 or 5 months, it will stay around 250. So I really don't want to sell my Microsoft stock. So basically, I want to avoid it being exercised. And I can see that as I go for a higher strike price where the chance of exercising is less, the premium is less, but that's okay with me. I will go for a 255 strike price option. Does that sound good to you?
Yeah, sounds great. How far out?
Well, 4 months for now um, uh, will be about May 2023. And I don't think the stock will move too much by then. So I want to sell one option of 100 shares of Microsoft that expires on the third Friday of May.
Okay. Let's see here. Pull up my screen. All right. Well, so you own the stock. Do you want to sell the covered call to minimize your risk?
Yeah, that's right, John. I usually do covered calls because I want to be sure that if it gets exercised, I have the stock and I don't have to run around and buy it at a high price. So it's a covered call that I'm looking for.
Okay, good, good. All right. You are all set, sir.
Thank you.
Thank you. I got to call Raj.
Ring, ring. Hey, John.
Hey, Raj, I just wanted to let you know that we sold your option for $3.95 a share.
Lovely.
We'll send it along to the clearing corporation. They'll let us know if someone exercises the option. They'll wire transfer the premium of $395 to us, and we will book it into your cash account.
Thanks, John.
Thank you, Raj.
Bye.
I got to call Raj.
Ring, ring. Hey, John. How are you?
I'm good, Raj. It sounds like you changed your ringtone. Anyway, guess what day it is?
Oh, yeah, it's Monday.
It is it's not just any Monday, my friend. It is the Monday after expiration date of your series.
Oh,
So this
yeah.
is a quick.
I saw on Friday at close, I still had everything, but I wasn't very sure whether somebody has exercised or not. So you're saying,
No, the price never went above 225.
wow.
Or I'm sorry, 255. So no one thought it was worth exercising. You're totally in the clear. You get to keep the money. If you log on to our portal, we do have a merchandise store, and you could probably spend a bunch of that premium on T-shirts, mugs, things like that. So
John,
be sure
let
to
me
do
stop
that.
you there. I'm all in for saving the money. So I've already made $395 without selling the share. So as I keep on selling these calls, I keep on making money and still keeping the shares, and that's what ticks me. That's what keeps
Okay.
me ticking. So what I would like to do is probably look at selling another option on Microsoft. And,
Awesome.
yeah,
Okay.
and I'm thinking that since it's near the end of May, another 3 months is August, and I think by then the Microsoft stock might be worth around 255 a share. So let's do an option for August, just $5 about that at 260, so that again no one exercises it, and I get to keep the premiums.
Okay, let me just check something here. Okay. I looked at the latest ticker info, and Microsoft calls August 23, 260. That's currently priced at $1.95 a share.
Oh, that's very low. That's very low.
Well, not a lot of people think Microsoft's stock's going to jump over 260 between now and then. So they're only going to pay a small premium. If you want a higher premium price, you may need to do an option that is further out on the expiration date. So what do you say? Are you willing to do an option series with a expiration date of, let's say, October? It's worth the money. Hang on, I'm not finished talking. It's worth the money because it's further out. It's got more of a chance for a buyer to see Microsoft stock jump to over 260 between now and then. I see on the ticker that the option series is traded with a premium of $3.25 a share.
That sounds good. That sounds
Yeah.
good, but it takes me way out, and that increases my risk because anything can happen in such a longer period of time, and my options could get exercised. But at the same time, if I went for 195, then it's not worth it with 100 shares because the cost, commission, and other things are going to eat into it. And it's not, and it will tie up my share because it's a covered call. I can't sell my shares either if there's a better price available in the interim.
Yeah.
So I see no other option but to go for 3.25 a share with a later time frame. I believe that's going to be October 23 for 260 strike price.
Yep. That's
Okay,
the
I'll
one.
go for that.
Okay, let's do it.
Thank you.
I'm putting the order in now. Bye, Raj.
Thanks.
I got to call Raj again.
Yes. Ring, ring. Hey, John.
Hi,
Did you get
Raj.
the options?
Yeah, I just wanted to let you know that we sold your option for $3.20 a share. We'll send it along to the clearing corp. You know the drill here. They'll let us know if someone exercises the option. They'll wire transfer the premium of $320 to us, and we'll book it into your account.
Thank you, John. As always, you're making money for me.
Good luck, Raj.
Thank you.
Bye-bye.
Bye.
Phone. John's brokerage. How do we do it? Volume, volume, volume.
Hi, John. This is Sam. This is our formal notification to you that someone who bought an option in the series of call Microsoft October 23 at 260 exercised them, and that we randomly assigned the delivery of that stock to one of your clients who sold an option in that series. His name is Raj. Now, here you go. You know the drill for us. You need to use the normal two-day time to deliver those 100 shares of stock. And you deliver it to me. I deliver it to the buyer. I will take the payment of $26,000 from the buyer and transfer it over to you. Remember that we as a clearing corp have guaranteed to the exerciser that this will happen. They'll get their shares. If your client fails to give it to us, you're on the hook for that. And if you fail to do it, you're facing some serious fines or liquidation. So no matter what, those shares have to come to us for us to make delivery.
Don't threaten me with a good time, Sam. But I know this was a covered call, and we have Raj's stock on book. So we'll immediately arrange for the transfer to the person who exercised it. Not to worry.
Fantastic. Thanks, John. We'll transfer the money from the exerciser to you in your account upon the transfer of the stock, and then it's up to you to transfer it into that guy, Raj.
Thank you, Sam.
Okay.
Oh boy, I hate these phone calls.
Ring, ring. Hey, John, how are you? Am I getting to keep my premiums?
Hi, Raj. I want to let you know that the clearing corp just called us this morning, and hate to tell you this, buddy, but somebody exercised your option for Microsoft at 260. So we're going to have to take that stock from your account and sell it to the person at the clearing corporation. that the clearing corp said exercised your option for $260 a share. So we're going to book $26,000 into your cash account.
Too bad. I was hoping that no one would exercise my option because I didn't think the price would go above 260. That's why I did the option. But anyway, I understand.
Nobody that sells a call option thinks that they're going to wind up in this situation going into it. So the clearing corporation just randomly spins a wheel, and unfortunately for you, this time your name came up. So the person who wrote the option series was somebody that exercised an option, and it was just luck of the draw. You got selected.
A deal is a deal. I think we have to abide by the deal, and I'm happy that I have made some money out of this.
As well, you should be, Raj. I mean, if you think about it for a second, did you make as much money as you thought you were going to make? Maybe not. Okay. But you also kind of, with this option, bought yourself a little insurance policy, right? If IBM had tanked, your premium would have offset that loss, right? So in a way, you could have done worse.
Yeah, I understand. And plus, I made so many rounds of premiums when the options didn't get exercised, and I collected dividends while I held the stock. So overall, I'm happy, John. Thanks for being my trader.
No problem. No problem at all. We're here for you anytime you want. And nice job of making lemonade out of lemons, my friend.
Thank you. Bye.
Take care.
Well, friends, that was a little bit of acting on our part. We enjoyed doing it. And I would just like to summarize quickly the lessons that we had to take away from this episode. First of all, it's always safer to sell covered calls because you have 100 shares of Microsoft, for example, in this case, in your account, and you're selling a call on those 100 shares of Microsoft. So if the calls get exercised, you are supposed to deliver the shares, and you already have the shares. So while you're booking the order to sell the call, you can decide what price you want to sell it at, depending on the premium, and also depending on your cost price. So you can always ensure that if the call gets exercised, you do not sell at a loss. So that's lesson number one. If you sell your covered call, it will settle on the Friday when it comes to NASDAQ. And on settlement day or before settlement day, whoever buys your covered call has the option to exercise it. And it can happen anytime, but if it didn't happen, then it's most likely to happen on the Friday. And if the share price did not reach your strike price at which you sold your covered call, you are lucky. You get to keep your premiums, and you can go back again, and in the next cycle, you can again sell a covered call for the same stock. So notice what's happening out here is that you're getting to keep your shares, and you're also earning premium, and you're also earning your dividends. So this is really good. However, if you were to keep the same share without selling options for, say, 2 years or whatever, the capital gains that you would have made in that may or may not necessarily be more than what you would get with doing covered calls successfully for the whole duration. And it all depends on the market conditions. Suppose on the expiry day, the share price is above your strike price, then whoever bought the covered call is going to exercise it, and you will have to sell it at the strike price, which is going to be less than the market price. And that's the reason why I emphasize that for newbies and for regular retail investors, the low risk of opportunity is to do a covered call, because you already have the shares in your account. You don't have to run around and buy the share at a high price in order to meet your obligations under the covered call. So that's the lesson in this entire episode. And as you saw there, we had enacted it the old way, where we'd have a brokerage to whom I would have to place a call, and then there would be the clearinghouse guy who would be talking to the brokerage and all that. But in terms of the current day scenario, you just have to open a trading account and everything can be done online. And whatever happens between the brokerage and the clearinghouse, you don't have to worry about it. It's all transparent. We just gave you that information for a bit of more context of what's happening behind the scenes, so you can be more knowledgeable on that. But nowadays, all of those things happens online, and it's you don't need to call anybody. In the next episode, we'll get back together, and I'm going to open my trading interface, and I'm going to show you how exactly a covered call can be sold. So that's what we are hoping. And please put your comments below. We have tried our best to improve with every episode. And we hope that this episode is better than the first episode. And the next one should be better than this one. So with that said, I would like to say bye for now. Thanks and have a great day. See you later.